many tillage farmers, they might be working away for 25 years and the farm size mightn't have changed, but the amount of machinery sitting in the yard has. So that all adds to your net worth, because if you were to sell that in the morning, there could be €1 million worth of machinery sitting in the yard that you've built up. You mightn't have built up land, but you've built up different assets. So it's worth looking at the trend over time to see what have you gained for your lifetime of work.
There's a saying that there's only two things in life we can't avoid, one of them being tax. Most farmers, and certainly their accountants, are very aware of this and spend considerable time trying to minimise their tax bill every year. But it's equally true that you must make a profit before you're liable to pay any tax. In reality, the profit you think you make and what appears in the set of tax accounts are often very different. So the question is, do you really understand the tax accounts your accountant prepares for you? You're listening to the latest episode of the Tillage Edge with me, Michael Hennessy. We really appreciate it if you could listen, follow and give us a review on Apple or Spotify or wherever you get your podcasts from. At first glance, reading a set of tax accounts might seem dull and tedious, but because these reflect everything that happens on your farm over the year, they can be surprisingly revealing, not just in terms of cost incurred through the year, but in also highlighting useful insights that can help guide future decisions for your business. In this episode, the first of two on the topic, I'm delighted to be joined by James McDonnell, a Teagasc financial specialist, to chat about where to start when looking for insights from your accounts. James, farmers have recently completed their financial accounts for 2024 and have their tax accounts with them. What insights or where should they start looking at those tax accounts?
There could be 20 pages in a set of accounts, and I suppose there's 5 or 6 key figures that you need to look at. The first one would be turnover. It gives the farmer an idea of the size of the business, and really all it is the total of sales. But in farming, overdrafts can be an important source of short-term credit. So the turnover, the bigger it is, the bigger the overdraft the banks will give you. So it's based on a percentage. So that's the first thing. The second thing would be to look at maybe the net profit. So it gives an indication of the return for the work that you've done on the farm over the last 12 months. Now, that can go up and down based on, the price of grain. And as you know, grain prices go up and down fairly. I suppose there can be big peaks and low troughs. So from year to year, you might be working hard and you get a low return. In other years, you don't work so hard because the year is good and you get a great return. But, it's good to measure and look at your net profit to trend over a few years as against what you're doing. But net profit doesn't tell you how much is in the bank account. So cash flow is really the most important figure that anybody should really be looking at. So it shows how much cash is available to provide for drawings, capital repayments on loans, reinvesting in the farm, and of course, you have to pay tax. And 2025, was a tough year for tillage, and you're paying your tax for 2025 in 2026. So if 2026 is a worse year, it's harder. But if it's a good year, it'll be no problem pay the tax. So, and cash flow, what's your cash flow? It depends on the time of day or the time of year. After selling lots of grain, there should be lots of cash in the account, but if you sow loads of winter crops, you're starting to use it up and you're clearing merchant credit and you're paying for things that were done. So it uses up quite quickly and you have to manage and budget that until this time next year when the next inflow of sales comes in. So cash flow is the next one. And then we'd look at net worth. So what are you worth after all your debts are cleared? So if you were to sell up in the morning and you sell your machinery and your land, it gives you so much money and then you clear your debts. So, that's figure is called the net worth. And what is the trend in your net worth over time? So if you were to go back through 5 or 6 sets of accounts, has your net worth grown in that period? If it has, you're doing things well. If it hasn't, it means you need to look more deeply into your set of accounts. So what's causing that? We all know the story of the farmer that has been selling sites over the last number of years too. to keep the situation going. So it's the opposite of that. So many tillage farmers, they might be working away for 25 years and the farm size mightn't have changed, but the amount of machinery sitting in the yard has. So that all adds to your net worth because if you were to sell that in the morning, there could be €1 million worth of machinery sitting in the yard that you've built up. You mightn't have built up land, but you've built up different assets. So it's worth looking at the trend over time to see what have you what have you gained for your lifetime of work. And I suppose one of the things, given where we are at in tillage at the moment, is to figure out what are the biggest costs in the farm, and maybe having a chat with your accountant, to is there ways, and your advisor, is there ways of reducing those costs? You know, we often talk about cost reduction, but you have to drive on output too. So the crop mix might come into it when you're talking to your advisor. So the costs and the output are worth looking at. So there's six different things to look at when you get your set of accounts back from your accountant. And I assume lots of people, they get the set of accounts, but they mightn't get the tax calculation. And it's probably worth looking at the tax calculation as well to see are there ways to mitigate that.
Okay, James, can I just jump in there for a second, just to I suppose maybe help ground this conversation because farmers really aren't used to looking at these sets of accounts, I suppose, from one year to the next. I might open them up for a couple of days and I mightn't see them again for another year. Just to ground it back a little bit, tillage farmers are used to looking at the Teagasc cost and returns, where you have the sales and the material cost and machinery cost, and it kind of gives a, if you like, a margin at the end. How does that differ to the net profit that they might see in the accounts? Because it might be easy to kind of say, there's X amount of net profit here. I'm going to divide it by the acres, and that's how much I made per acre. How are those two different?
Your cost and returns booklet is probably closer to the cash flow because when you look at the cost of sowing the crop, you've got the machinery, the ploughing, the harrowing, and the sowing and the fertilizer. Towards in the accounts, we're looking at as you drive the tractor down the field, you're wearing it out a little bit. So we've got depreciation in the accounts. So as you use the machines, you're wearing them out a little bit. And you have to put in a cost for how much of the tractor was used up by ploughing the 100 acres and how much of the seeder was used up by sowing 100 acres. So that cost is put in, but you don't actually take that cost out and put it into a separate account called depreciation. That money is still sitting in the bank account. So it probably adds to the when you look at your net profit, you have to add back the depreciation to get to a cash figure. So that's one place where things are different. If you look at your taxable profit, depending on how new the machinery or the sheds are in the farmyard, you mightn't pay any tax because you might have a large capital allowances bill. So that's something else that mightn't be in the cost and returns book.
And of course, in the cost and returns, there's things like insurance in there, land maintenance, the Jeep
Yeah,
is in there. There's other kind of things that probably are maybe slightly different in it. Just the other one then, in terms of, you mentioned a good bit about cash flow and profit, and you're kind of saying that they're obviously not quite the same thing, but where a farm might show a profit on paper or within in the accounts, but the farmer then is looking at the cash in the bank in terms of his bank account, a farm bank account, and it's not the same. Why is that?
oh yeah. So as I said already, the depreciation is one of those figures. So
Okay.
you do your accounts and it shows a net profit, and you have depreciation taken out as a cost. But because you didn't take that money out of the bank account and put it into a savings account to buy the next machine, that's still sitting there. So your bank account should read a little bit higher. Also in the accounts, there are certain there's a certain amount of drawings that might go on. So in the accounts, you have all the car phone and ESB, but there's only 70% of it allows to be written off against tax. So you have to add back some of those to balance up with your bank account figure. So usually there's a third that is not allowable. So that money might be spent in the bank account, towards it mightn't all be in the accounts. Depends on how your accountant does the figures. And then I suppose there sometimes, there's stock. So if it's a mixed farm, let's say you have decided that, with cover crops, you're going to buy in some sheep and you're going to graze the cover crops and you have 20,000 worth of sheep purchased for a few months. And they are still there at the end of the year. Well, extra stock on the farm is seen as extra profit. but the money isn't sitting in the bank account, it's walking around the field.
Hmm.
So that's another one that, causes a difference. And then when we talk about, um, the balance in the bank account, it's all about timing. So it depends on the time of the year that your bills come in. Because if we talk net cash flow, it's about what was in your bank account on the 1st of January, what's in your bank account at the end of the year. The net cash flow is the difference between the two. But it could be wildly different to what's in your bank account on the 1st of June or the 1st of October or even the 1st of December. Because as the basic payment and the crops get sold, now you're going to start, that money comes in, but you're going to start clearing invoices and clearing stock and loans and things like that. So timing is very important when it comes to cash flow, that when the invoice comes in, that you have the money there to meet it. So you might buy something, you might say, okay, can I buy something off you today, Michael, but I won't pay for it until the 1st of December. And you might say, okay, I can cope with that, but I'm not going to give you the best price. I'm going to add a little bit, because I'm essentially giving you credit for a few months. So you might add a few hundred quid to the price of the
Hmm.
item, you know. So yeah, so cash flow is about timing and making sure that when you write out the check that there's money there to meet it. It's a bit like, you're going to drive to West Cork and it's a couple of 100 kilometers. Do you need to fill the car up on the way down? So it's a bit like the fuel gauge on the car. So you can't do the job unless you have fuel in the car. So cash is
Okay.
like that to the business.
The other one that can come along a little bit, I suppose, is the fact that when the farmer or the accountant does up the tax accounts for the farmer and presents the farmer with a higher than expected tax bill, which might maybe come as a bit of a shock to the farmer and he's scratching his head about it. What do you think is the general reason behind, a slightly higher tax bill than might have been expected?
If you had a good year, Michael, and let's say 2024 was a good year and you have a decent tax bill, well, you have to pay preliminary tax for 2025. So a lot of people would pay 100% of the 2024 bill to cover 2025. So if one bill is large, then you're prepaying for the next year. So
Just to make sure I'm right in saying in what you're saying. So let's just say a farmer had a tax bill of obviously at the end of November, it's the tax year of 24 we're dealing with, not 25. And let's just say in that particular year there was 10,000 euros due in terms of tax. Are you
mm,
saying that the farmer would have to pay 10,000 euros for 24, but also 90% or another 9,000 euros for 2025 as well, in this November period?
yeah, well, that's the trust of it. But you might already have paid some money for 24 based on your 23 bill.
Okay.
So you have to settle up 24. And let's say profits in 24 were higher than 23. So there might be a balance to be paid there. But then you have to pay a preliminary tax for the next year. So when farmer sees the accountant tells him he needs 20 grand, some of it is for 24, some of it is for 25.
Okay.
The accountant might say to minimize your tax bill, you probably should put some money into a pension, and there might be some money for the pension as well. And you're writing it all out to the accountant, so you might think it's all tax, but it might not necessarily be. So it's about getting a breakdown and to know exactly what's going on is important.
And just bearing that in mind, I suppose, or in and around the tax bill, I mean, nobody necessarily wants to pay any more tax than they really need to. There's a number of ways of which, when a farmer gets towards the end of the tax year, that they can reduce that tax bill. Maybe you might just step us through a few of those.
Yeah, so we're in 2025 now, and we're heading towards the end of the year. So there's a few things that you could possibly do between now and the end of the year. So if the household has, other family members, you could form a tax partnership. If there's no other income coming in, you could split the income across other members of the family. So maybe there's teenagers and they do some work on the farm, but you'd have to pay them a wage and make sure they have a bank account. But you can't pay them a lump now. It's so much per week, for
So I think James, that has to go through full payroll bits and pieces and
it
all that.
would.
It can't just be a check
Exactly.
going across into their
No,
account
no.
kind of thing.
Yeah. Yeah, you have to have full payroll and you
Okay.
can pay up to certain limits before PRSI comes into play. If there's a spouse there and sure, I know from dealing with lots of farmers, there's often spouses doing farm work, but there's no money being, I suppose, divided across when the accounts are being done, even though work is being done. So, and sometimes if there's spouses with off-farm income, there's still probably a certain amount of the 20% threshold that's not being used to minimize tax. So a tax partnership could help that. Um, Another option might be, I would call them, some people call them revenue costs, but there are jobs that need to be done on the farm that are a direct expense. So maybe you haven't spread lime in a while. So if you spread lime, it's a direct expense, or maybe you haven't spread some P and K, and investing in soil fertility, or maybe there's a shed with a leaking roof and it's been leaking for a few years and a job needs to be done on it. So repairs are a direct expense, so they can reduce the tax bill.
What about the scenario, James? Here you mentioned that direct bill, that the a farmer decides there's great value in nitrogen, he buys it before Christmas, but more than likely isn't going to use it in the next year. Is that allowable in that year, or does that end up in the next year?
Well, strictly speaking, I suppose that's stock that's sitting on hand, but I suppose you can have a chat with your accountant and see what he thinks, because maybe there's always stock on hands at the end of the year. So,
Okay.
but I would think, repairs, and there's good grants there available. The TAMS grant for safety equipment or energy efficiency, or maybe some slurry storage that tillage farmers can avail of. There's accelerated capital allowances. So let's say you spend €10,000 on some farm safety equipment. So the accelerated capital allowances, what that does is it allows you write off the 10,000 across 2 years. Um, so if you're at the high tax rate, 40% of, so 5,000 capital allowances for 2025 and 5,000 capital allowances for 2026. If you're on the high tax rate, 40% of the 5,000 it reduces your taxable income. So if your taxable income is 100,000 and you invest 10,000 in safety equipment, 5,000 goes to 2025. 40% of that, um, 40% of the 5,000 is 2,000. So your tax bill is reduced by 2,000. So that's where how accelerated capital allowances work. So, you know, that's doing a job on the farm that needs to be done. Another one is making pension contributions. So let's go with the same figure. If you have 10,000 to invest in a pension, um, and let's say you're of the age that you get the full benefit of the 40% of making the pension contribution. So if you're 50 years of age, 30% of your taxable income could be put into a pension, which is a big figure. But let's say you make a contribution of 10,000. So if you make that contribution and you're on the high tax rate, you could get a check back from revenue for 4,000. And the 10,000 you put into the pension, you can get that back when you're 60. So it's a bit like a high
All
pay.
of it or some of it?
Well, it depends on how much you have in your pension.
Sure.
So up to certain limits, you can get all of it back if it's a small pension. But if it's a larger pension, you end up paying tax on it as you take it out.
Okay.
Okay, so it's worth talking to the accountant about where is your pension at? Do you have one? If you're in the lucky position, because paying tax means that you're doing a good job at the business, you're making money. So then it's about, minimizing the tax so that you can retire early or have a more comfortable retirement by making those contributions. Another option might be income averaging. Now, income averaging can be tricky. Like it's good in a high tax year in that you're pushing out the tax to a future year. But then in a year where you have low income, now you've brought forward the tax that you should have paid in a high income year into a low income year, so it's more difficult. Now there is a step out clause if things are really tight that you pay no tax in 1 year. I think it's 1 year in five, but your average is recalculated. Sometimes income averaging is used. There are maybe health expenses and mortgage interest and they generally come to small figures that you could make sure you're claiming those. And there's lots of advertisements on the radio, usually at this time of the year, that make sure that you're claiming those expenses against your tax. And finally, there's the forming a company. So lots of dairy farmers have done that over the last decade because money has been good in dairy farming, but they come with a health warning. It's not something you.
And James, just interrupt you there. We might just come back to the company in just a second, but can I just go back one step, if you don't mind, back to the income averaging?
Yeah,
In a tillage scenario, as you know, you mentioned earlier yourself, there's some very good years and there's some not so good years. It's very up and down and in and out. Is income averaging more suited to a business like that, or is it more suited to a kind of a stable income kind of every year on year?
well, if your income is stable, you don't need income averaging because there's very little volatility in the income.
Hmm.
But income averaging is useful where incomes are volatile. So in a good year, you're not paying a huge tax bill. The problem is when you have a very poor year that
Okay.
you've brought forward the tax to a year that you mightn't have much money.
Yeah.
So if I was going into income averaging and I had a very good year, you paid a low amount of tax, but you put some money aside for the next tax bill because you don't know what next year is going to be like. You've crops in the
Sure.
ground now, you don't know what the spring is going to be like. So you could possibly reduce, your tax bill over time because you're paying less at the high rate and more at the low rate. That
But
that
but but
could
to, but
happen.
but 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 to get the most out of it, from what I'm hearing from you, there needs to be a bit of internal discipline from the farmer themselves. That there's almost, you're kind of saying to yourself, I'm going to pay 10 grand every year. Some years it might be 20, other years it might be zero, but I'm going to have 10 grand in reserve there along the way, so
Yeah,
it'll be easy for me to meet.
exactly. Yeah, yeah. There should be some money kept aside because you don't know what way the year is going to come.
We might just come back in the next episode and talk a little bit more about forming a company and where you should do it and where you mightn't do it. So great, James. Listen, thanks very much for today, and we'll chat to you in the next episode.
Okay, thanks, Michael.
So that's as much as we can get through today, and my thanks to James for joining me about the topic. Join us next week for part 2, where we look at the companies and why these can be useful in certain circumstances. So finally, if you enjoyed the podcast, then recommend it to a friend or colleague. And as always, review and follow on Apple or Spotify so you never miss an episode. And for more information, go to teagasc.ie. I'm Michael Hennessy. Thanks for listening. I'll be back next week with more tillage news and advice.